Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, April 30th. The first quarter increase in real GDP at a 0.6% annual rate undermines concerns that economic trends are deteriorating rapidly and even that the economy is in recession. This is not an aberrant number. Inventories added 0.8% to the overall gain, and skeptics will be quick to point out that that would have declined at a 0.2% annual rate without this swing factor. However, inventories do reflect economic activity and belong in the calculation. The other component trends reflect surprising resilience and even strength that suggests the outlook for second quarter GDP is surprisingly good. Housing remains very weak. Residential construction fell at a 27% annual rate and took 1.2% off the real GDP change. No surprise there. What may come as more of a surprise to many is that real personal consumption expenditures, or PCE, the bottom line on consumer spending, was up at a 1% annual rate and added 0.7% to the GDP change. Consumer spending, which comprises about 71% of GDP, has continued to rise through the first quarter despite declines in payrolls, lower home prices, and rising gasoline prices. Those are all dampening consumer spending but are not sufficient to cause a pullback. The export boom continues. Net exports added 0.2% to the GDP change. Government spending, meanwhile, was up, no surprise there, and added 0.4%. Business investment in equipment and software was extremely resilient and was essentially flat, declining at a 0.7% annual rate. There has been no serious decline in such investment as typically occurs in recessions. Manufacturing is often perceived as weak, but industrial production, factory orders, and shipments all remain essentially flat. Non-residential construction, which is most likely office buildings, fell at a 6% annual rate and is one sector of the economy where downward momentum is accelerating. It amounts to 3% of GDP. The near-flat trends in PCE and business investments suggest that the economy will hold up in the second quarter. The export boom may even accelerate. Housing will remain weak, but the rate of deceleration will slow. All this would lead to a near-flat second quarter real GDP except for one factor. The fiscal stimulus will kick in. The likely impact of the $110 billion in checks to consumers is widely underestimated. It will lead to a surge in consumer spending that will boost second quarter real GDP growth to the 1% to 2% range and provide an even stronger boost in the third quarter. The numbers this morning provide strong support for the argument that there will be no decline in real GDP for any quarter this cycle. It undermines alarmist concerns about a serious deterioration in the economy. Separately, the GDP deflator was up at a 2.6% annual rate. That was less than the feared 3% annual rate, but a bit higher than the 2.4% in the fourth quarter. This may provide as much good news for an inflation-concerned stock market as the GDP number itself. I'm Pat O'Hare for Briefing.com. Thanks for listening.